take it away in terms of the global economic growth right now.
Caroline, you mentioned that Euro area GDP off 12%. So come and take a look at this chart here that I'm showing inside my terminal, because we know yesterday, of course, we also got that U.S. GDP number showing on an annualized basis a 35% drop. And then, of course, overnight, we also got some China PMI data. All of this really putting into question the global recovery that is or is not underway. Of course, global GDP estimates now looking at a 2020 drop of 4%. And then, of course, hoping for a gain here in 2021 of 5%. For more on the global markets, we're joined now by Bill Lee, Milken Institute chief economist. Bill, thinking about some of the GDP data that we're receiving, how are you looking at the U.S. recovery relative to Europe, relative to China at this moment?
Well, I think all of this COVID talk has really lulled investors into a state of complacency about what's going on in the world. We know that Europe is starting to recover because they seem to be doing better in terms of the virus treatments and containing the spread of the virus. But we also know that European economies have been structurally very slow to grow, and they have to now restructure to a new globalization where supply chains are much less globalized. They are very dependent on China. We saw from the PMI data that China's industrial production has gone up, but their consumption and domestic demand is faltering. And so there's a lot of question about whether, even if the global economy were to get going on a supply side, will the demand side be there to support it? And there are some severe doubts about that. And here in the United States, we need to really worry about how our domestic demand will be bolstered by the fiscal package.
And so, Bill, then, with regards to the fiscal policy, and you fold that in with some of the monetary policy elements that have sort of at least helped to stabilize global economies overall, is there a sense here that the tools or the methods that are available to policymakers out there have sort of run their course right now, and that you have to come up with something new, something different in order to sort of get us that next sort of bit of stimulus?
Let's remember that the Federal Reserve put out a whole bunch of new policies and new approaches to monetary policy, where it's not just the traditional channels of lower interest rates and flooding the markets with liquidity. They're much more worried about supporting the structural markets, making sure that debt markets were able to function and actually channel the funds to the right places. Now, one thing that they've been surprised by is that with all of the packages and loan policy packages that they have in place, there's hardly any take-up. In fact, their balance sheet looks like it's stalled and probably even starting to contract. So we have to worry whether or not the Fed is really pursuing the right policy transmission channels in this very strange post-COVID environment. And I don't think they are, because people don't want to borrow unless there's real demand. There's no demand out there because people are afraid of going out and spending the way they used to. So I think the new tool that we really need to consider for the Fed to put in place is buying equities, and not becoming an investment banker, but doing what the HKMA did, doing what a lot of the BOJ has done, buy equities to support the equity markets, because it's through ownership that we're going to have the innovations that are needed to transform our economy more appropriately to a post-COVID environment. We need innovations. We don't need more of the same. We don't need lenders to say, I don't want you to innovate because I want to make sure I get my money back.
But Bill, we've already seen the Fed wade into buying corporate debt at the moment, and everyone's saying Apple, certainly now at the tune of $1.7 trillion market cap, does not need its bonds bought. Why on earth would equities need to be purchased? Would it have to be focused just on, say, the energy industry?
No, in fact, I think it's going to be toward the smaller businesses. We need to have essentially special purpose vehicles where a lot of startups and a lot of small businesses like restaurants and retailers who want to innovate and say, okay, I know I'm not going to have a lot of people-facing activities going on in the next several years, so let's transform ourselves. Let me be a restaurant that has a lot of ghost kitchens where I can deliver good food to people without having them to come into my restaurant. But how am I going to pay for that? Banks are not going to lend that to me because that's too innovative. That's too risky. It takes equity ownership, and if we have a lot of equity ownership, which by the way is now, we have a lot of capital out there waiting to be invested in private equity pools. Why not securitize some of that stuff so that it spreads the risk around and allow the Fed to support the markets for doing that?
Bill, fold some of this analysis, as you were mentioning, on prices with the weaker dollar. You mentioned Europe, mainly German economies are a big export economy. With our weaker dollar, do we import higher inflation, or can we start to see some increasing exports if this weaker dollar does persist. How are you folding in weaker dollar analysis with some inflation scenarios as well?
Well, Taylor, as you know, the Fed would pray and love to see some inflation come in, whether it's through imported prices or whatever. And I don't think that's going to happen because no one has pricing power right now. And the weaker dollar is just going to compress a lot of the profit margins. But one of the things that we need to worry about is whether the weaker dollar is going to be a persistent trend. It's still the case that the United States is the place of innovation in the global economy. And people look at the United States as a source of strength and a source of safety. So as much as we've had some weakness in the dollar and seems to have stretched out a little bit longer than it has before, I don't think it's going to be a long enough persistent trend to really influence the global financial flows in a very meaningful way. We'll get a lot of speculative flows that blow out of the dollar and into other assets to try to take advantage of the quick jump in exchange rate. But the investment dollars, the real stuff that creates jobs in the long run, is not going to be affected.
So we've got a couple of critical Fed meetings coming up in the fall in September, and obviously the big November 5th one, which is sort of sandwiched right around the election here in the U.S. What's sort of the main metric that you think policymakers are going to be looking at to assess whether the steps they've taken so far have been effective, and whether they need to maybe do something more or just kind of let everything ride its course?
At the macro level, there's a lot of talk about trying to be very specific about how long this period of indulgent monetary policy is going to persist. And of course, they're going to tie it to some kind of outcome, whether it's inflation or some combination of a Taylor rule that combines output and inflation. One thing I need to worry about, and I think our viewers need to worry about, is the Fed is engaged in a lot of these micro-financial policies of supporting debt markets. How do they measure that? How do they know they're doing well? And that's something that we have no metric about. And that's the discussion I think they're going to have to go on, because they're going to ask themselves, are we succeeding at the micro level in getting funds to the places that it has to go? Or are these loan programs, because they're not being taken up at all, are they a failure and do we need to look elsewhere? And how do we judge success and failure at the micro level? That's something that's not in the standard toolkit of the Fed, not even in the analytic evaluation toolkit of the Fed, and that has to be worked on.
Yeah, and that's something that Powell, of course, has alluded to and kind of raised the alarm with congressional policymakers there to maybe do something about that. Bill, great to have you on. Always very smart. Bill Lee, he's the chief economist over at the Milken Institute. And a quick programming note here. David Weston's